So today we've got a real head scratcher for you from the world of retail. We're talking about Trent, the Tata Group's powerhouse. See, it's this fascinating tale of a company that's absolutely firing on all cylinders, but its stock is telling a completely different and kind of gloomy story. Let's dive in and figure this out. Here's the central mystery. How on earth does a company report its best sales ever and then watch its stock price just crater by 30% in a single year? It doesn't seem to make any sense, right? Well, that's the puzzle we're going to piece together today. Okay, so let's start with part one, the record-breaking quarter. Before we get to the stock market drama, you have to understand just how well the actual business is doing. And honestly, the numbers are fantastic. Get this. The top-line number is almost 5,345 crore rupees in net sales for just one quarter. This isn't just a good number, it's the highest quarterly revenue in the company's entire history, really powered by a strong festive season. And it's not just about how much they sold. The net profit is up, with a massive 36% jump from the last quarter. But the real star of the show here might just be that operating margin. That huge leap shows the company is becoming way more efficient and a lot more profitable on every single thing it sells. And this isn't some one-hit wonder either. The company's return on equity is a super strong 26.58%, which is way above its average. That means it's using shareholder money really, really effectively. You add in the power of its brands like Westside and the explosive growth from Zudio, plus, the backing of the Tata Group, and on paper, this company looks like an absolute beast. So everything sounds pretty perfect, doesn't it? Well, here's where the story takes a sharp turn. Welcome to part two, the billion-dollar but. This is where things get tricky, because for investors, amazing results, sometimes they're just not enough. To really get why, we need to talk about one key number, the P/E ratio, or price to earnings. It's actually pretty simple. It just tells you how much the market is willing to pay for one single dollar of a company's profits. A really high PE means investors are betting on some seriously massive growth in the future. And Trent's PE ratio, it's 88. Let that sink in. Investors are willing to pay $88 today for every $1 of Trent's current earnings. Now, that is a sky-high expectation. It means the market isn't just hoping for growth, it's pricing in absolute perfection. And to put that 88 into context, is that a big number? Oh yeah. It's way higher than the sector average of 74, and it absolutely dwarfs a top-tier competitor like Page Industries, which sits at 50. When it comes to how expensive this stock is, Trent is really in a league of its own. And it doesn't stop there. The PEG ratio, which kind of balances price with growth, is over 4.6, and usually anything over 1 is a red flag. The stock has underperformed the entire market by almost 37 percentage points. And if you're looking for income, forget it. The dividend is basically nothing. All of this just screams risk to the market. So all of this leads us to part three. Investors are divided. How is this wild mix of great business performance and a crazy high valuation actually playing out? Well, it's created a massive tug-of-war in the market. First off, let's take a look at who actually owns this company. The Tata Group promoters, they have a solid 37% stake. But the really interesting parts are the big slices owned by foreign and domestic institutions. These are the big fish, the major players, and they could not be on more different pages. Just look at this timeline. Over the past year, you can see a super clear and completely opposite trend. Foreign institutions, the FIIs, have been selling, slashing their stake from over 21% all the way down to under 16%. And at the exact same time, domestic institutions, the DIIs, have been buying it all up, boosting their stake from 15% to over 21%. It's this huge rotation, with foreign money getting spooked by the price tag and domestic money betting big on the long-term story. And that brings us to our final section, where we put it all together. Quality business, risky price. It's time to put both sides of this coin on the scale and try to make sense of it all. You can really break the whole conflict down like this. On one side, you have every reason to love the business. It's a market leader, has strong returns, proven growth from brands like Zudio, and that solid Tata backing. But then you flip the coin over and you've got an investor's worst nightmare. An extreme valuation, terrible recent stock performance, foreign investors fleeing, and a lot of volatility. It is a perfect split personality. And this quote from the analysis really just hits the nail on the head. The 30% decline represents a valuation reset, not a fundamental deterioration, yet current levels still price in perfection. So in other words, the stock fell because its price was based on a fantasy, not because the business itself got any worse. The business is still great, the price was just too high. So this all leads us to the final verdict from this analysis. The company's quality, it gets a good grade. Its financial trend, positive, but its valuation is very expensive and the stock's technical trend is bearish. So when you put it all together, that super high price tag outweighs the strong business, leading to an overall analyst rating of sell, just because the risk versus the reward doesn't look so good right now. And this leaves us with a huge question, one that every single investor has to wrestle with. We know Trent is a great business, no doubt about it, a leader in its industry. But that brings us to the ultimate dilemma. For a truly great business, what price is the right price?